all, and welcome back to Money Managers, a User's Guide. This week, we finally got a NASDAQ correction. Rates continue to rise, and we have the first credit casualty of 2021, Greensill Capital, which built an empire in something called supply chain finance. Essentially, this is lending a supplier money upfront for a receivable, thereby creating a secured lending facility. Apparently, Greensill committed the cardinal sin of concentration in counterparty risk with the Gupta Industrials enterprise, and so we have private equity buzzards descending in their droves around Greensill. And this affair has claimed another liquid alternative fund, the $842 million GAM Greensill Supply Chain Finance Fund, which is shuttering due to a large investor redemption forcing a wholesale, orderly liquidation. GAM states that there are no valuation issues and expect the short-dated secured loans to be repaid, but we'll see. Guarantee you, the other 9 investors in the fund didn't appreciate having their liquidity turned off, so the whole fund could be liquidated at a future date. These funds don't offer particularly high returns, and they are typically used as an enhanced cash instrument by institutional investors, offering a yield premium over other cash instruments. Overall, this is another professionally annoying situation from my perspective, because if you have secured lending happening with maturities less than 12 months out and a 60-day average life, that is your real liquidity, not the daily liquidity these funds offer. Now, they're not like the money market funds that started the global financial crisis in 2007, which were forced to break the buck that defined their stable value promise. The GAM fund's investors expected its valuations to vary over time, but if we take a look at Venn, its returns were very regular. The statistical concept for this is kurtosis, or the lack of tails in the distributions of returns. A standard bell curve has a kurtosis of 3. GAM Greensill had a kurtosis of 153, with 953 days out of 1,201 of its life nestled right in between 0 and 0.01% of a daily return. Let's take a look at the returns on a monthly basis. And it looks like nothing ever happens until the fund closes. The worst global pandemic and economic deterioration contraction in a century never happened if you look at the returns of this fund. But now, a very large and prominent financier is seeking a bailout, and this fund is now going into liquidation, reneging on its liquidity promise. Let's call this fund what it is, a fiction of offered liquidity engineered to raise money from pools of capital that weren't designed to land on short-dated secured terms. As an industry, we should leave this kind of liquidity transformation or shadow banking in the dust. If I scan the market for the highest sharp, highest kurtosis funds, it is populated exclusively by various secured lending or insurance-linked security strategies, where any basic investigation of liquidity in the underlying instruments wouldn't square with their offered terms. All the investors in these funds are sitting around the table in a perverse Nash equilibrium, clipping coupons and hoping no one actually needs their principal back, because otherwise the whole game stops. How lame. All that rah, 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 you're playing yourself, you're playing yourself, you're playing yourself. All that rah, 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 you're playing yourself. Thanks for tuning into this short little rant. Stay safe out there, and if you like this content, like, share, subscribe, comment. Every interaction keeps this channel alive. And remember, use your money manager. Don't let them use you. Thanks.